The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Hello, and welcome to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes-ish or less. So whether you are a seasoned federal employee or just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we'll tell you what you need to know but might have missed in the federal space this week. We are your hosts. I am Katelyn Murray, and I'm joined by Mr. Dan Sipe on a particularly rainy day.
Yes. Gray all over the East Coast. So let a smile be your umbrella if you're in our time zone, and hopefully you have sunny weather if you're not.
I like that. Let a smile be your umbrella. Very good. Very good. Well, we, rain or shine here at Serving Those Who Serve, we are bringing you the news and information that you need to make informed decisions about your financial well-being. And on today's episode, that means talking a little bit about college planning, which is a less covered topic. I know we like to talk about retirement and tax planning and things like that.
Sure.
But college funding is important and impactful for families, and it can, if done improperly, it can impact retirement pretty significantly. So I'm going to talk a little bit about 529 plans and a really interesting article on different ways that you can use those plans. And then Dan is going to talk with us about a tried and true topic here, which is IRMAA. So how IRMAA is calculated, what the heck a 2-year look back is, and all that good stuff.
Indeed.
So before we get into that, I want to kind of bring everybody's attention to a pretty good article, kind of a unique article on 529 plans that is on STWServe.com currently. It's called 29 Ways to Use a 529 Plan, including some new rules and some expanded uses that we have seen. So what a 529 plan is, if you're not sure, we want to make sure, obviously, that we're educating you on the basics, of course. So a 529 plan was created under Section 529 of the Internal Revenue Code in 1996 to help families save for college. Now, recent legislation, including the Secure Act 2.0, which was a couple of years ago at this point, and OBBBA, which was just this past summer, significantly expanded how 529 plans can be used. So today, 529 plans can absolutely support education. That's kind of their baseline. But they can also support career training, student loan repayment in some cases, and even retirement planning through Roth IRA rollovers. Yes, that's right. You are hearing me correctly. There are certain situations where we can take money in a 529 plan and roll it into a Roth IRA. Very cool application there. So in general, if you're looking to leverage a 529 for traditional college expenses, you're going to want to look at eligible expenses. So with the 529, the deal is you put the money in after tax. You can take, in some states, depending on where you live, a state tax deduction, not a federal, but a state tax deduction for up to a certain amount that you put into a 529 for that year. And the money grows tax-free. And as long as you pull it out for eligible expenses, you don't have to pay taxes on that money ever, right? So you're putting the money in. In some cases, you're taking a state tax deduction at the state level. It's growing tax-free and you're pulling it out. So at the state level, there is a way to use a 529 plan where those funds are effectively never taxed at the state level. Now, the federal level, always going to be taxed on the money that you're putting in. Okay. What are eligible expenses? Well, that's a good question. They include, but are not limited to, mandatory fees, college tuition, And that can include four-year universities, community college, grad school, trade school, and some vocational training, required textbooks, school supplies, and lab equipment, and then computers, laptops, printers, educational software, internet access that's required for coursework can be included. You're going to want to make sure to check on your state's 529 website just to be 100% clear that an expense is eligible. But
Sure.
what I would add to that is tracked expenses. You have to have receipts for these things, because if the IRS comes knocking, or if your state comes knocking and wants to know, did you use this money on eligible expenses? You need to have the information there to say, yeah, here's exactly what was spent on. You can do your 529 reimbursements once a year. So you can just pay for all those things out of pocket, keep your receipts, and once a year, dip into the 529 to take care of that. Or in some cases, you can pay directly from the 529 for things like tuition expenses. Housing and student living costs can be included in eligible expenses from a 529. On-campus housing is kind of a no-brainer, but off-campus housing up to the school's published room and board allowance can also qualify for 529. Now, if on-campus housing is $15,000 a year, and your rent adds up to $20,000 a year, what that means is $15,000 of that $20,000 would be reimbursable from the 529, and then the other $5K would be an ineligible expense that you'd want to cover through cash flow. Meal plans, eligible study abroad programs are part of this, and some dual enrollment college courses that are taken during high school can be tapped for the 529. Now, we're not going to get into all 29 uses. I want to give you a baseline for what 529s are, and I'm going to refer you to our website, STWServe.com. The article is called 29 Uses for Your 529. I will give you some highlights, okay? Previously, we were able to dip into 529s for K-12 private school tuition for up to $10,000. That has now been doubled. It has been increased to $20,000 that you can pull out of that 529 for private K-12 tuition and fees. There's a really interesting one that I think could appeal to some folks, or certainly maybe children of kind of our base. The Secure Act allowed for a $10,000 lifetime limit per beneficiary for student loan repayment. So if you did end up financing a portion of your college tuition, you could use 529 funds to pay that back, or you could route your repayment of that student loan through a 529, especially if you live in a state where you can capitalize on state tax deductions, okay? Sometimes good finance is musical chairs, all right? If that confuses you, reach out to the team at STWServe at meetings@stwserve.com. And I lastly want to touch on Roth IRA rollovers, because this is a big thing, okay? So this came in with Secure Act 2.0. And basically, it allows you to take unused 529 funds and roll them into a Roth IRA for that 529 beneficiary. Now, this is subject to certain conditions, okay? So let's say you were really good at saving for college for your kids, and they graduated, top of their class, of course. They moved on to have a great career, and now they're kind of trying to establish themselves as a young adult, and they're in those kind of growing phase years, right? And you want to help them out. There's money left over in the 529. You can absolutely do that with this 529 to Roth IRA rollover in certain cases. So your lifetime rollover limit is $35,000. Okay. So you can't move more than $35,000 from the 529 into the Roth IRA. The annual contribution limit for a Roth IRA still applies, and that is at $7,500 for 2026. So what that means is, yes, I can roll a lifetime limit of $35,000 over from my kids' 529 into their Roth IRA. But as of 2026, it would take me 5 years to move that money, right? Because I can only move over $7,500 per year. Now, if you are listening to this podcast episode in between January and April of any given calendar year, you might be able to do 2 rollover contributions, because you can do potentially a prior year contribution. So just be mindful of that. The 529 account, however, generally has to have been open for at least 15 years. Okay. So this is really truly geared at unused 529 funds, not let me open a 529 and route a Roth IRA rollover through it. Okay. And Really important, lastly, the beneficiary must have earned income equal to the rollover amount up to that annual contribution limit. So if you're doing this for a child who graduates college and goes off to the Peace Corps, you may not be able to do it for a couple of years because they've got to have that earned income, unless they have earned income elsewhere, again, up to that $7,500 that is the annual contribution limit. If they only have $2,500, no biggie, you just do $2,500, and it takes you longer to hit that lifetime rollover limit, provided you've got $35,000 left in the 529. This is a really powerful strategy for folks who do have leftover 529 funds because it can help you jumpstart the Roth 5-year clock early for your kiddo. And it helps reduce concerns about overfunding a 529 plan. That is probably the number one question I get about 529 plans is I don't want to overfund it. And it depends on your own goals and your context and your values. But I encourage folks to kind of look at unused $529 either as, seed money for a Roth IRA to help your kid out after college, or as a sort of education trust, right? Because unused 529 plans for your kid could be used for a grandkid potentially. So, education in my book, never a bad investment. We do want to be mindful about the way that we approach things. But, I think that there's worse things that you could blow your money on than your child's education. So absolutely. I highly, highly encourage you to check out this article. There are a lot of creative, intentional uses for 529 plans there. We just really covered the highlights here in this podcast episode. But I want to leave room for Dan to explain what the heck IRMAA is to all of us. I hear this 2-year look back, these windows, and I really just don't want to pay $1 more for Medicare Part B than I have to, Dan. So tell me about it.
Okay. It's not your Aunt Irma. Okay. It's income-related monthly adjustment. And basically what it means, if you or your household income is above a certain threshold, you can be charged more for Medicare Part B. So that's at its core. A couple of things to understand. It's based on modified adjusted gross income, not just taxable income. So what the heck does that mean, Dan? That means, for example, tax-exempt interest. A lot of our feds of my vintage have some tax-exempt bond funds or bonds out there. So that would factor in. And Medicare uses income tiers to determine the Part B and Part D like dog surcharges. So for 2026, the first IRMAA threshold is for an individual, $109,000, and for married filing jointly, $218,000. So you asked about the 2-year look-back rule. For reasons of their own counsel, Medicare uses income for what you'll pay this year from what you earned 2 years ago. So, for example, 2026 Medicare premiums were based on the 2024 tax return. And therefore, 2027 premiums will be based on 2025 and so on and so forth. So, financial decisions that you make today could affect you 2 years hence. So, what income counts towards it? Traditional IRA and 401k or thrift savings plan withdrawals, required minimum distributions, which basically can come from both of those or all three of those, pension income, taxable Social Security benefits, capital gains, dividends, interest income, and tax-exempt municipal bond interest. So retirement income planning really needs to keep an eye on managing total modified adjusted gross income over the years, not just minimizing taxes, but making sure that we're not steering ourselves into a higher Medicare Part B premium. Now, one of the things we're not going to talk about here is, does a Fed need Part B? We have a whole FEHB, Medicare, and TRICARE webinar for that. We have tons of articles about it that address that debate, and it is a debate out there. This is talking about if you have decided you are going to be in Medicare Part B, what do you need to know? So you need to be careful because timing matters. One of the things that can be very popular is required minimum distribution age for most people is 73 or 75. So between the time you retire and you reach those ages, it's become very popular to do Roth conversions. So take your traditional monies, move them over to Roth. You owe taxes on those. You do them in the wrong year, they can trigger a higher IRMAA premium 2 years later. So you need to keep your eyes focused on what you're working on, but you also need to be looking down the road. So planning involves balancing long-term tax savings with potential short-term Medicare premium increases. And why that's important is there's kind of a cliff effect to those IRMAA premiums. So it uses thresholds rather than a progressive or gradual phase-in. So exceeding that threshold by even $1 can move the retiree into that higher premium bracket for the entire year. So that's where you have to be careful. Again, not going to get into does a person with FEHB need Medicare Part B? But if you have decided that you do, then you need to be mindful about decisions you're making today and what it's going to do with those premiums in 2 years. But if you are in FEHB and some of the FEHB plans give you a reimbursement towards your Medicare Part B, generally it doesn't include the IRMAA part. Okay. So that's something to keep in mind. You may be going along blissful that, my Blue Cross Blue Shield kicks a certain amount towards this, only to find out that it's going to be higher than what you think. So we always like to give you some actionable things at the end of these. Spread income over multiple years when possible. Time your Roth conversion strategically. Okay, so you're not doing so much that it's going to bump you up over the next time. Think about harvesting your capital gains during lower income years and coordinate those withdrawals across all of the retirement accounts. One thing that I'm a big fan of, and if you're blessed to be in a position for this, certainly pretty powerful, don't be bashful about using QCDs, qualified charitable distributions, where you're eligible to reduce taxable income and also meet your charitable goals. Okay. The big thing is IRMAA planning is a multi-year process because of that 2-year look back. So key takeaways to kind of sum it all up. IRMAA is based on modified adjusted gross income, uses a 2-year look back. Okay. That makes income timing an important factor. Retirement decisions involving Roth conversions, withdrawals, harvesting investment income, FEHB coordination, that can all affect those future Medicare costs. But we believe incorporating an understanding of IRMAA into the overall retirement income strategy can reduce the likelihood of unexpected out of the blue Medicare premium increases. If you have more questions about it, as Katelyn said, head to the website, read the article. Again, we have a great webinar that covers it. We're here to help. We want to help you make the best decisions. And I hate to say it, I think that's all we have for today. But have no fear, folks. We'll be back next week to bring you the latest updates you need to make informed decisions about your career and financial well-being as a Fed.
Indeed. And analytics shows us that about 78% of folks watching our videos, I think we now have gotten that down to 74. So you guys are listening. But if you are not subscribed and you're listening to this video, if you're watching this video on our website, for example, if you will click through to YouTube and subscribe to this podcast on our YouTube channel, if you're watching there, on Spotify, if you are an audio-only listener, we love you guys as well. If you subscribe, that will help you never miss an episode, but it also tells whatever platform you listen to us on that this is important information that they should share with others. So that's always helpful for kind of boosting the signal. And if any of this resonated with you or somebody that you know, please feel free to reach out to them and just send them a direct link. Just spread the word, helping more Feds.
Absolutely. And for more information about the topics we've covered today and even more, be sure to check out our blog at STWS.com and subscribe to our newsletter, The Weekly Serving. And then you'll get the latest news delivered straight to your inbox every week. Don't even have to go looking for it.
And for those who want to dive even deeper into learning about your federal benefits and financial planning for Feds, we encourage you to join us for one of our complimentary webinars. Now, we've got some good ones coming up. We've got TSP planning coming up on August 19th. That is always a great jumping off point for folks who are just kind of getting in. You probably know what TSP is, but I doubt that you know as much as you will after that webinar. So again, August 19th, 11 a.m. to 2 p.m. Eastern Standard Time, and that will be with Dan and myself. And then the following week, I believe, maybe 2 weeks after, on August 26th, we're going to be having our FEHB and Medicare webinar. Now, that one is from 10:30 a.m. to 2:30 p.m. I know what you're thinking, 4 hours. Whoa, but there's a lot of information to go over, and it is very valuable from a time investment standpoint. And that will be with Ed Zerndorfer, the federal benefits guru, and Dan Sipe. So you got two choices, and they're both Dan. Love it. Love it. Now, if I hear you, if you don't have 3 or 4 hours to set aside for a webinar, that is totally fine. If you want a one-on-one approach, feel free to reach out to our team directly for a financial planning consultation at meetings@stwserve.com.
Absolutely. That's where we are. We're waiting to help you. So thank you for listening to Fed15. I'm Dan Sipe.
And I'm Katelyn Murray.
And we will see you next week.